Joining us now, Kathryn Rooney Vera, Financial Chief Market Strategist. Kathryn, in some ways it feels really binary, right? It keeps going down or it goes up. Like those are the only two options and has a lot of repercussions in the market. What do you think? Is the summer of disinflation over?
Well, I think disinflation is continuing through year end. My forecasts for core PCE are for 3.8% by year end 2023. My concern, however, and Mohamed El-Erian put it very, very nicely visually, is that inflation becomes takes a smile visual, and that is that we get a reacceleration in 2024. The Atlanta Fed, in their nowcast, put out an estimate for 3Q of 4.1%. I have 1.8 in my forecast. 4.1% is double potential growth here in the United States. So if we, in fact, get close to 4% for 3Q after 2 and change in 2Q, plus real wages positive and trending higher, plus consumer confidence robust, plus 3.5% unemployment and a red-hot labor market that's still strong. It's slightly rolling over, but still strong. Then I think it's very unlikely that we get service sector inflation in a service-based economy sufficiently contracting to get to the 2% core PCE target. So next year, Guy, I think 2024 is going to be, the Fed's got to choose. They've got to choose if they have a strict interpretation of their dual mandate or if they change it.
I hear what you're saying, and they've got to figure out how they deal with these cuts that are currently priced in. We were talking about that just a moment ago. Kathryn, to what extent is the market broadly priced for that? How big a shock would that be for assets? Which assets would react the most in that kind of environment? Say the Fed sticks with the idea that it has to get inflation back down to 2%, and inflation ain't going in that direction. How big a market adjustment do we need to see, and where?
The best trade right now, Guy, in my view, is counter-cyclical portfolio policy. That's preparing for the worst. Because right now the markets are pricing in the best possible scenario. And as we know, that generally doesn't play out. There's going to be kinks in the road. So 100 basis points around there of cuts next year, in my view, is very unlikely to happen. Inflation could be sticky around 4%. It could reaccelerate or just not come down from 4 to 2%. The heavy lift is going to be core PCE going from 4 to 2, not headline from 9 to 3. So what I like right now is last week on Bloomberg, I recommended naked on Qs. It's worked out really well. Cash, 5.5%, looking really good. Gold. But even short duration tips make sense to me because Jan 2025's, for example, real yields 3%, nominal 5%. The implied inflation there is 2%. If inflation remains sticky around 4 or just isn't 2, then you get a nice return from tips of about 7%, the 4 plus the 3%. So I think that's another way to protect portfolios right now.
So, Guy, this also brings into question sort of the long end of the bond market, for example, because I feel like hedge funds are shorting and asset managers are buying. And I feel like it sets up a term premium increase that we haven't really seen. And I kind of wonder if, in terms of the long end, we're in a dicier spot, Guy, when it comes to potentially the disinflation ending.
In some ways, long-term asset managers have to hold some of this stuff, so they're buying it for that reason.
Exactly.
I think an elevated term premium story is an interesting one. I was listening to Ira talking about this. He says that you kind of get these phenomena that don't last very long. At the moment, it's being driven a lot by supply. But normally you'd be expecting the market to steepen in a completely different way. And this is the point. You'd expect short rates to come down. We're not seeing that. We're seeing the exact opposite. It's just confusing as to what is happening here. Kathryn, what message is the long end telling us?
It's so fascinating. I couldn't agree more with you, Guy. I mean, if you look at the push-pull on the 10-year, you have inordinate fiscal deficits. You have a big supply coming out of Treasury. You have the Japanese yield curve control kind of going away or expanding the ability for yields to rise. That incorporates repatriation of capital. So that's negative for the 10-year yield. But then on the flip side, you have the Fed coming to the end of its target, and you have peaking inflation. So I think there is a push-pull there. The recommendation at StoneX we had last week was on steepeners. It worked out really well. I think, however, that if you have the perspective that I have, which is that there's a real chance of inflation reacceleration, then you're going to want to be careful and perhaps do the opposite, play a flatten or play the payer receiver you can pay fixed, receive floating. I think that makes sense. I think the markets are discounting a continuation of disinflation. I've never been a believer of immaculate disinflation.
Yeah.
It just doesn't make sense in a consumption-based economy with a strong full employment and real wages finally turning positive.
So I know you mentioned gold earlier. So is that like a strong buy commodity call then, if we're going to prep for that acceleration?
I wouldn't go through the whole commodity complex. I think China is not going to come with this massive stimulus that we've historically seen in the past. So it's more of a play on inflation potentially surprising to the upside. So I like having that safety net, the cash, the gold, the sectors. I think Guy or your previous guest mentioned how certain sectors, I think it was Mike McKee, how the economy starts to contract after the yield curve has bottomed out. And that's correct. So if that's correct, after the yield curve has bottomed in terms of inversion, you want to be long defensives. You want to be long staples, utilities, healthcare, and energy.
Yeah, all of this is happening at the same time, Kathryn, as the government continues to support this economy, continues to pump money into the system, continues to provide an economy backstop that is totally different to one we've seen for a while. The government is keeping the economy going and looks like it wants to do so for a while. How does that change the narrative?
Well, a lot of people compare the rating downgrade to 2011, and there are some similarities. But what isn't similar is the trajectory of the fiscal deficit and debt at this juncture. The U.S., in many aspects, the ratios are comparable more to the emerging market names, but still enjoy massive investment grade ratings. So why is that sustainable? Because we have the U.S. dollar. It's the sovereign reserve currency of the world. There is no substitute. Until there is, we can keep this party going. China has $3 trillion in reserves. The deepest, most liquid market is treasuries, and they're going to continue to support that market. I do, however, think that there's going to be a hard look, and I think the fiscal situation merited this downgrade. It makes no sense, in my perspective, for the U.S. government to be running a near 9% fiscal deficit when we have, at this moment, full employment. We need to be engaging in counter-cyclical fiscal policy, not pro-cyclical.
Kathryn, great to see you as ever. Thank you very much indeed for stopping by. Kathryn Rooney Vera, StoneX Financial. Always great to see you. Thank you very much.